Answer.
Get the latest weather, traffic, and news updates online at 560theanswer.com. Now, from the Signature Bank Studios. Only the biggest stories, only the biggest guests, and only the biggest opinions. This is AM 560, The Answer.
Top of the morning, Dan and Amy, hearing from a lot of successful entrepreneurs over the last several days on Trump and trade and tariffs. We addressed David Sachs's comments in a back and forth with Larry Summers early in the program, where Sachs, who's Trump's crypto guy, and billionaire, tech investor, co-host of that popular All In podcast, he suggested that Trump needed to do what he did to establish his leverage in forthcoming trade negotiations. Chamath Palihapitiya was on with Laura Ingraham, and I appreciate he and a couple of others we'll get to also addressed what Trump inherited, because just as important as all, and perhaps more important than what we're discussing with respect to tariffs and trade deals, is that budget resolution framework that is sitting in the Senate and that needs to advance not only Trump's tax relief plans, but the spending restraint key. Palihapitiya on with Laura Ingraham.
The amount of debt that they created and issued, the amount of short-term obligations that they created for the U.S. Treasury are, frankly, unconscionable. The reality is that for the last 40 years, whether they want to admit it or not, Donald Trump has been right. When we admitted China into the WTO in 2000, we thought we were getting the best of it, but we didn't. We did a very bad deal, and they won overwhelmingly.
I'm not sure I'm in complete agreement with that, but the first part of him talking about what the Biden administration did is running up unconscionable short-term IOUs is on the money. Ray Dalio, who is the founder of Bridgewater, which is the largest hedge fund in the world, was on Meet the Press over the weekend and expressed some worry, as did Larry Fink over at BlackRock, worry about something worse than a recession. And they both talked about sort of concerns about reordering global trade, like discarding the post-World War II paradigm for something different.
I think that right now we are at a decision-making point and very close to a recession. And I'm worried about something worse than a recession if this isn't handled well. A recession is 2 negative quarters of GDP, and whether it goes slightly there, we always have those things. We have something that's much more profound. We have a breaking down of the monetary order. We are going to change the monetary order because we cannot spend the amounts of money, so we have that problem. And when we talk about the dollar and we talk about tariffs, we have that. We are having profound changes in our domestic order, how ruling is existing, and we're having profound changes in the world order. Such times are very much like the 1930s. I've studied history, and this repeats over and over again. So if you take tariffs, if you take debt, if you take the rising power challenging the existing power, if you take those factors and look at the factors, those changes in the orders, the systems, are very, very disruptive. How that's handled could produce something that is much worse than a recession, or it could be handled well.
Yeah, I mean, the headline from Dalio has been, it could be much worse than a recession, but he's talking about multiple variables, and he is not saying it's inexorable that a recession or something worse could happen. It's how you manage what you're attempting to do. Larry Fink had basically something very similar to say.
Well, we've had now 20 plus years of supply chain creations. And, another economic force, Jim, post-World War II was consumerism. So we built the whole foundation of economic policy around consumerism, providing Americans with the cheapest products. Right. And so that was the foundation. Now, did that come at a cost that some of our communities were decimated, where they lost jobs? Absolutely. So maybe we went too far on the whole concept of consumerism. But let's be clear, the major economic foundation was based on consumerism. And so we wanted our companies to go around the world to find the best places to provide the highest quality at the cheapest prices so we could consume more. And we always thought that type of consumption was the most progressive form of economic behavior. More people could have more, and that was one of the fundamental reasons why the United States was the leader.
Yes,
because our citizens were huge consumers. By now changing this equilibrium, it's going to be harder to consume, and we're going to have elevated inflation.
Well, that assumes that the equilibrium is being changed fundamentally, which I'm not so sure that's the case. For more on this, Christopher Whalen joins us, chairman of Whalen Global Advisors, LLC, editor of the Institutional Risk Analyst, and author of Inflated: Money, Debt, and the American Dream, second edition, released to be released this May, next month. Chris Whalen, thanks for joining us. Appreciate it.
Good morning, Dan. Good morning, Amy.
So distill what you heard from Dalio and Fink, and to some extent Palapattia as well.
I agree with you. I don't think that we're seeing fundamental change. Donald Trump is certainly raising the visibility of the trade issue and the deficit issue. But really all he can do is engage with other countries with the threat of tariffs, right? And say to them, I want a more equal relationship with you. In other words, we're not going to be the engine of growth. We're not going to fuel the GDP of all the nations of the world by borrowing money. Because, when I was listening to that clip from Larry Fink, that's great. We're buying stuff cheaper, we're doing global sourcing, but we're paying for it with public debt. And if you do this on a credit card, obviously at a certain point it doesn't work anymore, right? So that's, to me, the underlying issue. I don't think President Trump has a lot of flexibility here. He pretends to, and he's certainly gotten the discussion going. But I don't think you can change things like trade flows and investment flows overnight or in weeks or months. It just doesn't work that way, Dan. We can start to change it, but, this is a long-term issue. And that's why I wrote a piece this morning. I said, look, guys, do your homework. Let's go shopping. Because to me, this whole kerfluffle of the last week is going to be a buying opportunity.
That's interesting. I mean, that's why I said I appreciate, even though I often disagree with them and sometimes wonder how they became billionaires. Dalio and Fink both did raise the issue of debt and that spending restraint. So going back to that pending budget deal, spending restraint was a key part of stabilization here. As much or more so than discussion about particular tariff rates on particular products from particular countries.
Well, precisely. What's so interesting is that most of the comments you hear in Wall Street last couple of weeks are really about the equity market. If they even talk about interest rates, they do so in this very two-dimensional kind of way, rates up, rate down. But what you've seen over the past 6-9 months is that spreads, in other words, the difference between treasury rates, mortgages, corporate debt have been widening. Mm-hmm. And in the last couple of weeks in particularly, we have seen an enormous widening of spreads for high-yield debt and for less creditworthy companies. That's bad because that's how we finance the U.S. economy. The high-yield sector, the double B and the triple C rated companies that are, kind of on the border, they still go out and raise money. And when they can't raise money, the whole show stops, Dan. That, to me, is the big warning sign that we're seeing.
And when you say the whole show stops, what does that mean?
The bond market.
Yeah.
We love talking about equities because it's easy to talk about. It's like tariffs. Everybody loves to talk about tariffs because it doesn't really require any technical expertise. But you start talking to people about the bond market and the credit, and their eyes glaze over. They have nothing to say. And yet it's the most important part of the market. Equities are sexy. They're kind of a political barometer. Everybody looks at the Dow every day. But ultimately, where we finance economic activity is in the bond market. And boring as that may be, it's a lot more important.
Well, and this is, so I've been saying the same, what I think you're saying too, when you just said this is a buying opportunity. What I see is Trump playing by, frankly, the same old rules. He's just put the full court press on because he's on an expedited timeline politically. And
he's in a hurry.
Yeah, he's in a hurry. And the net of this is going to be 6 months, 8 months from now, we'll probably have deals with our major trading partners that are sort of like the difference between NAFTA and the USMCA, slightly better, and then we'll carry on.
That's right. We're going to divide countries into those that we really don't have a problem with, but we do want them to open up. Let's face it, the European Union is not the most open economy in the world. They have more restrictions on one another than Donald Trump is putting on them, okay? And I think it's always important to remind people, I talk about this in the book, that Franklin Roosevelt was a lot more protectionist than Donald Trump on his worst day. I'm sorry. You know, so they're going to work it out. The issue is China and some of the other rogue states. They're going to have to, I think, you know, basically leave those 150, 200% tariffs on China, because there is no way to engage with the Chinese on fair terms. They're not interested in that. The Chinese are interested in asymmetry, both in trade and in military affairs, and they want to be able to dominate the countries immediately around them and then have a predatory relationship with other states because they want to make more money from them than they spend, obviously, right? They are like Great Britain in the 17th and 18th century. They are the great predatory mercantilist state. And they, in fact, learned it from the British, obviously. So.
Well, right, but and my concern is that, and I think some of what we're hearing allays that concern. My concern is that, whether it's his actual philosophy or not, that this was the road that Trump was going to go down, is to, as you heard from Fink, rather than we subsidize consumption, which I don't think we should do. I don't think we should subsidize anything, but that's me. But the idea is we're going to essentially model ourselves after 17th century Britain or 20 and 21st century China, which is we're going to subsidize production like they do at the expense of consumption.
I think there's a more interesting agenda here, a narrative that's really not articulated by the Trump people, which is not only do they want to have a conversation about trade, but they also want to devalue the dollar. They'd like to see the dollar go down 10 or 20%. And, you know, it's almost like we've revivified John Connally, the former, Texas governor who was Treasury Secretary under Richard Nixon. And everybody always goes on and on about Nixon closing the gold window, but it was really FDR who took gold away from Americans as a monetary asset and then put us through the Great Depression. He did a currency devaluation, too, which was a disaster. But we always forget that, right? We don't talk about that.
Well, let's talk about the
wait a second. I do want to talk about that because that's a part of the concern. I mean, you say that's more interesting. That's more dangerous. I mean, I know it's a way to finance debt, but that's not, that's not a sound monetary policy.
No, competitive devaluations are never a sound policy. But here's the thing: when you are the operator of the global reserve currency, and you've gone through the period you were just talking about, the debt accumulation during Joe Biden, did you hear the world complaining? No, they love it. They love the fact that the dollar is 88% of total foreign exchange transactions in the world, okay? So we're running this utility for people, but our consumers and our businesses too pay for it with inflation. So the question is, how do you break out of this trap without destroying the global economy? You don't want to have competitive devaluation the way we did in the 30s. That's exactly what Roosevelt did. All the other nations of the world had to get off gold after he did that. So, we are repeating history. Fink is correct. But this, it's always different this time. There's different components, and inflation is our problem right now.
Yeah, well, so how do you do it without competitive devaluation? Is you stop the printing press and the government and then the distribution of government largesse?
That's correct. If you can attack the deficit in an effective way, then yes, that's a big way to do it. But also you have to somehow or another incentivize Americans to stop buying the cheap stuff from overseas, because the alternative is not going to work. Imagine if automakers in the U.S., particularly somebody like Ford, had to source all of their components domestically, starting right now. The price of their vehicles would go up 20-30%.
Right.
Easy. So this is a long-term process. We can't fix this in months or weeks. And that's the trouble is that, Trump is in a hurry. He'd like to get all this done in the next 3-4 years. And he has been talking about this going back decades. If you go pull the clips on Donald Trump,
from the 80s.
He's been talking about this forever.
Yep.
Yeah.
Well, what about farmers? I feel like they're stuck in the middle of all this, and they're most in limbo because China came out and said, you know what, we don't need our soybeans from Minnesota. That's the number one export to China is soybeans. Kentucky, Illinois. We're going to get our soybeans from Brazil.
Yeah, good luck with that. China is still an extremely weak, vulnerable country, and they're very vulnerable on food. So if they want to play that game, God bless. I think that's going to be a disaster for them.
Yeah, but just philosophically, it'd be interesting your take on this. They do call to mind the Soviets in the respect of their internal contradictions because they're communists, prevent them from ever realizing the strength of their numbers. And it's the same thing. I mean, with the Chinese Communist Party, it is a house of cards, but taking a more radically free market approach, I think would expose those paradoxes and impose penalties associated with those contradictions much more quickly and severely, don't you?
Oh yeah, the Chinese state first and foremost targets political stability and political control. If you started making decisions in China based on economics, the whole system would fall apart, and members of the Communist Party would be hanging from lampposts. That's the issue. The communists in China have more debt than we do.
Yeah,
they're imploding because of debt, and remember, they never pay it back. There's no leverage in China. You make the loan's gone, and nobody ever pays it back. So that's why they are constantly having to bail out their quote-unquote banks, what they call banks. But there are no banks in China. There's just one thing, which is the Communist Party. That's it.
Just going back to Fink and Dalio because of how concerned they expressed themselves to be in the short term that this could go sideways quickly and badly. If it's not, I don't know what they believe, but let's say they don't actually believe that this is anything other than playing by the old rules of the game more aggressively and with greater pace. Why are they talking then about this belief in a in a paradigm shift? Is there something else afoot? I guess is my question, because they're too smart to be this stupid sort of thing.
I think the thing that's worrying them in the short term is that in the second quarter, because of the stock market reversal, you could see assets under management fall, and that means they're going to earn fewer fees. The whole paradigm that has made BlackRock and all of these other firms big is that we have always had an equity market that's expanding several times the visible rate of inflation. So if you change that, and let's say we were back in the 70s and we had a flat to down equity market for a couple of years, these big firms would no longer be growing. Their earnings wouldn't be growing. And let's remember, their other little game, the private equity world, is a complete disaster. High interest rates have turned that into a liquidation, and you're going to read and hear a lot more about that this year. Because guess what? Who owns all that stuff? Pensions, all sorts of investors that are supposed to take care of people, insurance companies, right? They're all going to take a shellacking through the private equity and the related credit problems in that sector.
So they're being a little less high-minded than they would otherwise want you to believe.
They're talking their book. That's what they do,
Okay. All right.
They've made money on inflation. What's interesting is when I talk to really smart people like the ones you're talking about, is they say, well, Chris, we've seen this huge increase in net worth. We've seen the expansion of, assets and everything else. It's good, right? And I say, yeah, but you're funding it with debt. So, it's always a fun conversation when you remind the neo-Keynesians of why the numbers keep going up. That's the issue, really.
Chris Whalen, chairman of Whalen Global Advisors, editor of the Institutional Risk Analyst, and author of Inflated: Money, Debt, and the American Dream. Second edition releases next month. Pre-order it now. Chris, thanks as always.
Have a great day.
Thank you. And he joined us on our turnkey.pro answer line.
Listen to Dan and Amy on your smartphone. Download the AM 560 mobile app today at 560theanswer.com/mobile.